There are a number of overlapping reasons for the increase in financial turmoil over the past month. One is markets have grown increasingly concerned about what's going on in China, not just the deterioration in growth, but also the question about whether policymakers are in control of the situation. Second, the plunge in oil prices is unsettling markets, in part because a lot of leverage is built up in commodity producing countries and commodity producing firms over the past few years. Third, the Federal Reserve has started to tighten policy, which means that some of the liquidity support for the global economy and also the buffer for risk assets that had been in place is being diminished. Fourth, geopolitical tension has been rising, whether that be in Europe due to the immigration crisis, in the United Kingdom because of Brexit concerns, or the Middle East, rising tensions around Syria, Saudi Arabia and Iran. And finally, all of this is going on in a backdrop in which valuations are stretched in many risk assets, and so investors are growing increasingly concerned about whether those valuations can be justified. Our expectation is that we'll go through further bouts of turmoil through 2016, so investors can't be complacent about this sort of stress in markets dissipating. Before the recent rise in financial stress and turmoil, we were already expecting 2016 to be a challenging year for the global economy. A number of countries, whether that be Brazil or Russia, were expected to remain in recession. Global growth was going to be very patchy and very reliant on consumer spending in the developed economies to propel overall growth. The increase in financial stress introduces sort of new downside risks to that global outlook. There is a lot of evidence that suggests that when credit spreads widen and equity volatility increases, equity prices decline, that there are spillover effects into broader economic activity. Firms cut back on investment spending, hiring growth slows, consumers feel more nervous about committing to large ticket items, and so their saving rates can increase. So our expectation is that that isn't enough to drag the global economy into recession this year, although it's possible that growth moderates a little bit. However, we are monitoring the situation very carefully for signs that that financial stress is spilling over into a more deep slowdown in global economic activity.